What if I told you that right now, as you're watching this video, the silver market is sitting on top of one of the most explosive setups we have ever seen in modern financial history, and most people have absolutely no idea what's coming? I'm OG John AG, and today, February 20th, 2026, I need to break something down for you that is genuinely alarming, genuinely exciting, and genuinely a once-in-a-generation kind of moment. So if you haven't already hit that subscribe button, do it right now, because this is exactly the kind of deep analysis that will make the difference between being prepared and being blindsided. Let me start with the raw numbers, because the numbers today are absolutely staggering. As of 10:23 UTC this morning, silver XAG/USD is trading at $81.07. That is a gain of 3.39% from yesterday's close of $78.41. In dollar terms, that's more than $2.50 in a single day. And gold? Gold is sitting at $5,040, up 0.88%, holding firm above that massive psychological and technical level of $5,000. Let that sink in for a second. Gold above $5,000, silver above $81. We are in completely uncharted territory, and yet the biggest moves may still be ahead of us. Now, let me take you deeper, because the surface numbers are just the beginning. Here's what's actually driving this move today. You've got three major forces converging all at once. First, a weakening US dollar, which historically has a near-perfect inverse relationship with precious metals prices. Second, the market is now pricing in approximately 2 Federal Reserve rate cuts for 2026, and lower interest rates mean the cost of holding non-yielding assets like silver and gold drops dramatically, which pulls enormous capital. And third, and this is the one I want you to pay close attention to, escalating geopolitical tensions, particularly US-Iran developments, are triggering what's called safe haven flows. When global uncertainty spikes, money floods into gold and silver. We are seeing all three of these forces hit simultaneously, and the result is what you're watching today. But here's where it gets even more interesting. The key resistance levels right now for silver are $82.50 up to $85. If silver can break above $82.50 convincingly and hold there, the technical setup points toward an acceleration toward $85 and potentially beyond. Support on the downside sits between $80.45 and $80.70. That's your line in the sand. As long as silver holds above that zone, the bulls are in control. Below it, we could see a retest of $77.50 to $79, and that would actually be a buying opportunity, not a reason to panic. For gold, resistance sits at $5,050 to $5,090. The demand base, the floor where big institutional money has been stepping in, is right around $5,031 to $5,034. As long as gold holds there, the trend is intact, and today's flash Q4 GDP data and PCE inflation report coming in at 8:30 a.m. Eastern are going to be massive catalysts. If inflation comes in cooler than expected, we could see silver rip straight to $82.50 or higher within hours. If it runs hot, expect a short-term flush toward support before buyers come back in force. Now, I need to talk to you about something that most YouTube channels are not diving into, and that's the structural deficit story underneath all of this. Because this is where the real bull case lives, and it's backed by hard data. The silver market has been running a structural deficit, meaning demand has exceeded supply for 5 consecutive years, 5 years in a row. And in 2026, we're projected to enter year number 6 of that deficit. Think about what that means. From 2021 to 2025, the cumulative silver deficit reached approximately 820 million ounces. To put that in perspective, the entire world only mines around 820 million ounces of silver in a full year. So we have consumed in just 5 years of deficits, the equivalent of an entire year of global mine production. That silver came from somewhere. It came from above-ground stockpiles, from exchange inventories, from vaults in London and New York, and those stockpiles are not infinite. Let me give you the year-by-year breakdown so you can feel the weight of this. In 2021, the deficit was roughly 75 to 89 million ounces. In 2022, it exploded to as high as 272 million ounces, the largest single-year deficit in modern history, driven by industrial demand from EVs, solar panels, and green tech. In 2023, another 194 to 210 million ounce deficit. In 2024, roughly 151 to 176 million ounces. In 2025, the deficit moderated to about 95 to 149 million ounces, as supply edged up slightly, but demand still crushed it. And for 2026, the Silver Institute projects a 6th consecutive deficit of 67 million ounces, even as supply is expected to hit a decade high of 1.05 billion ounces. Here's the uncomfortable truth. Supply simply cannot keep up, and the reason is structural. Approximately 80% of silver production comes as a byproduct of mining other metals, lead, zinc, copper. That means when silver prices go up, miners can't just flip a switch and produce more. The supply response is slow, constrained, and limited. Meanwhile, demand keeps growing relentlessly, especially from industrial sectors. Solar energy alone consumes roughly 100 million ounces of silver every year, and that number is growing. Electric vehicles require silver for their battery management systems and electrical components. AI hardware, 5G infrastructure, medical devices, silver is inside all of it. This isn't speculation. This is where the world is physically going, and it is eating silver at a rate the mining industry cannot match. Now here's the number that should really grab your attention. JPMorgan, one of the largest banks on the planet, has set their 2026 silver price target at an average of $81 per ounce, with Q4 potentially hitting $85. But that's the conservative call. OWAG Funds is targeting $133 per ounce. Bank of America has floated scenarios as high as $309. And then there's analyst Michael Oliver, who has publicly predicted $500 silver and $8,000 gold by summer of this year, framing everything we're seeing right now as a shakeout before the most violent leg of this bull market begins. Now, I'm not here to tell you Michael Oliver is definitely right. But I am here to tell you that when a respected technical analyst makes a call like that, and the data underneath it, the deficits, the industrial demand, the geopolitical pressure, the Fed pivot, when all of that data actually supports the direction of that call, you have to at least take it seriously. Let's talk about China, because this is the piece that most people are completely missing. The Shanghai market, primarily the Shanghai Futures Exchange and the Shanghai Gold Exchange, has been trading silver at record premiums over Western spot prices. We're talking premiums of up to 45% above COMEX prices when you include VAT for exports. That kind of premium means one thing. China desperately wants physical silver, and it is willing to pay a massive markup to get it. And when Shanghai premiums are this elevated, arbitrageurs ship physical silver from Western vaults eastward, tightening supply in London and New York, and putting upward pressure on global prices. We just came through the Lunar New Year holiday period, where Chinese markets were shut down for roughly a week. During that shutdown, silver prices became erratic and volatile because approximately 25 to 30% of global silver demand simply went offline temporarily. Now that Chinese markets have fully reopened, that demand is coming back, factories ramping up, industrial buyers restocking, retail investors re-entering. This post-Lunar New Year demand surge is one of the near-term catalysts that could push silver through $82.50 and into that $85 zone. On top of that, China has implemented export controls on silver, similar to what it has done with rare earths, making China a price setter for the global silver market. These controls limit silver outflows from China, tighten global physical availability, and add another layer of structural support to prices. And I have to address the mining sector, because this is where the real leverage is for investors who want amplified exposure to the silver move. Senior silver miners have delivered a 92.7% compound annual growth rate over the past 2 years. That is nearly 93% per year, massively outpacing even silver itself. The reason is something called operational leverage. When silver goes from $50 to $80, a miner whose cost of production is $20 per ounce sees their profit margin go from $30 to $60. It doubles. So the stock moves much more than the metal. Names like Pan American Silver and Hecla Mining have been the major beneficiaries of this dynamic, and as long as silver prices hold elevated, the miners continue to benefit disproportionately. Now let me give you the full picture on risk, because I always keep it real with you. The RSI, the Relative Strength Index on silver right now, is elevated, signaling overbought conditions in the short term. That doesn't mean the rally is over, but it does mean that chasing at $81 without a pullback plan is dangerous. If silver shows signs of a lower high, or if buying momentum fades and passive rebounds rather than fresh conviction drives the price, that's distribution, meaning smart money may be selling into the strength while retail buyers chase. A failure to hold $80.45 to $80.70 could see a quick flush to $77.50 to $79, and that zone would be where I'd be watching for re-entry. The next FOMC meeting is March 17th to 18th. PCE data today will shape rate expectations going into that meeting. If inflation surprises to the upside, hawkish bets increase, the dollar strengthens, and silver faces headwinds. That's the bear case in the near term. But the structural bull case, the deficits, the industrial demand, the geopolitical tension, the Chinese premiums, none of that changes based on one data print. The longer-term trend remains firmly bullish. So where does this all land? Here is how OG John AG is framing this moment. Short term, watch $80.45 to $80.70 as your support floor. If silver holds there, the next move targets $82.50, then $85. Break $85 with conviction, and you're looking at potentially $90 to $100 before any major pause. On the downside, a loss of $80 opens a path to $77.50 to $79, which is a discount, not a disaster. Medium term, the 2026 deficit of 67 million ounces, combined with China's demand resurgence post-Lunar New Year, combined with the Fed cutting rates twice this year, points to sustained price support and likely higher highs. JPMorgan's $85 Q4 target starts to look conservative in this environment. Long term, and I want you to really hear this, if the cumulative deficit continues through 2027, as analysts project, and above-ground stockpiles continue drawing down, and industrial demand from solar, EVs, and AI keeps expanding, the silver market is structurally set up for the kind of price discovery that we haven't seen in a generation. Whether that means $133, $183, $309, or the extreme case of $500 that Michael Oliver is calling, I don't know the exact number, but the direction of the evidence is clear. If you think the deficit story is alarming now, let me peel back another layer that's got me genuinely concerned about what's coming in the months and years ahead. This isn't hype. This is based on the latest projections from the Silver Institute and major institutions, and it's the kind of structural reality that could reshape entire industries if it plays out as forecasted. First off, let's talk about the inventory crisis that's unfolding right under our noses. COMEX registered silver inventories, that's the physical silver available for delivery in New York, have plummeted more than 70% since 2020, dropping from highs around 400 million ounces to under 120 million ounces as of early 2026. London vaults are reporting similar tightness, with physical supply bottlenecks that are forcing premiums higher and delaying deliveries. Why is this alarming? Because these inventories are the buffer for the global market. With deficits projected to continue, we're drawing down these stockpiles at an unsustainable rate. The Silver Institute estimates that by 2030, cumulative deficits could exceed 1.5 billion ounces. That's nearly 2 full years of global mine production wiped out from above-ground supplies. If demand keeps surging and supply can't catch up, we're looking at potential physical shortages that could disrupt manufacturing lines worldwide. And speaking of demand, let's zero in on the green energy boom that's about to hit a wall. Solar photovoltaic demand for silver is exploding. It hit around 200 million ounces in 2025, up from 100 million just a few years ago, and projections for 2026 show it climbing even higher as countries like the US, China, and Europe push for net zero targets. Add in electric vehicles, which use up to 50% more silver per unit than traditional cars for components like wiring and batteries, and AI data centers that require silver in high conductivity chips and cooling systems. The World Bank and IEA are warning that without a massive supply response, these sectors could face cost overruns and delays. Imagine solar panel prices spiking 20 to 30% because silver inputs become scarce. That could slow the entire renewable transition, hiking energy costs for everyone and stalling progress on climate goals. This isn't some distant theory. Citigroup analysts are already forecasting silver hitting $100 by March 2026 and $110 by mid-year, precisely because of these industrial pressures colliding with depleted inventories. Now, comma layer on the geopolitical powder keg that's only getting hotter. We've got US-Iran tensions at a boiling point with the Trump administration's 10-15-day deadline for a nuclear deal expiring soon. Any escalation there could send oil prices through the roof and trigger even more safe haven buying into metals, but don't sleep on the broader risks. China's export controls on silver are tightening global flows, similar to what we've seen with rare earths, and potential US tariffs on imports could exacerbate the East-West supply divide. Analysts at ING and Kitco are highlighting how policy uncertainty from Fed independence questions to trade wars is amplifying volatility. If we see a flare-up in Taiwan Strait tensions or renewed Russia-Ukraine escalations, silver could become a go-to hedge, pushing prices into triple digits overnight. The Silver Institute notes that in volatile environments like this, investment demand alone, coins, bars, and ETFs could surge another 10 to 15% in 2026, widening the deficit from 67 million ounces to something even more extreme. Here's the data to back it up. Total global silver supply is forecasted to hit a decade-high 1.05 billion ounces this year, up 1.5%, but demand is still outpacing it, leading to that 6th straight deficit. Mine production? It's inching up, but with 80% as a byproduct, we're at the mercy of base metal markets like copper and zinc, which aren't expanding fast enough. Recycling helps, but it's capped. We're already at record levels there. If industrial demand grows just 5% more than expected, which is plausible with AI hardware ramping up, that deficit could balloon to 100 million ounces or more per scenarios from Metals Focus. But I wouldn't be OG John AG if I didn't keep it balanced. The alarming part is real, but it's not a doomsday scenario yet. If the Fed sticks to its 2 cuts and inflation cools, watch that PCE report dropping in just a couple hours, we could see a controlled ascent rather than chaos. On the flip side, if tariffs bite hard or geopolitics ignite, the volatility could lead to sharp pullbacks before the next leg up. My advice? Use any dip to $77.50, $79 as a loading zone, but always have stops in place below $75 to protect against black swan events. Wrapping this up, the silver market in 2026 isn't just about trading charts, it's about a fundamental mismatch that's got real-world consequences for tech, energy, and global stability. We're talking potential delays in EV adoption, higher costs for AI infrastructure, and a squeeze on medical devices that rely on silver's antimicrobial properties. This is why I'm pounding the table on preparation. Stack physical if you can, consider miners for leverage, and stay diversified. This is not a story about a one-day trade. This is a story about one of the most compelling structural imbalances in any commodity market on the planet right now. And today, February 20th, 2026, silver just hit $81.07. Remember where it was when you watched this video. If this kind of deep analysis is what you're looking for, real numbers, real data, real context, then subscribing to this channel is one of the most valuable things you can do for your financial awareness right now. Hit that subscribe button, turn on notifications, because the next few weeks in the silver and gold market are going to be absolutely critical, and I will be here breaking it all down for you every single step of the way. This is not financial advice. Always do your own research. I'm OG John AG. Stay sharp, stay informed, and I'll see you in the next one.